But these banks would do it in order to hold the price down. They're getting beat now. They're getting beat because of deliverability. That is what is different. And that is what I've been saying with you since 2020. It's different. And now it's accelerating. And, it's accelerating. And I think that's the genius of what these countries have done. Most of us think, well, why wouldn't they just buy it all up? Because just like that, you would blow up the system. You're done. Cut off your nose, spite your face, the whole system blows up. But instead, they slowly have drained the system.
Recent activity in the precious metals market is underscoring a structural shift that extends well beyond short-term price movements. Delivery figures show substantial volumes of gold and silver being taken off the exchange at the very start of the month, continuing a pattern that has persisted for several years. Andy Schectman notes that the financial commitment required for this level of physical acquisition places it firmly in the hands of sovereign entities, major financial institutions, and large industrial consumers. These participants are not reacting to volatility. They are positioning in anticipation of future constraints, signaling that physical ownership has become a strategic priority rather than a tactical trade. Schectman explains that current price swings are largely the result of market mechanics, particularly repeated increases in margin requirements during periods of low liquidity. Such actions disproportionately impact leveraged traders, forcing liquidations that temporarily push prices lower. However, these declines are quickly absorbed by well-capitalized buyers who are operating outside the margin system altogether. Unlike past cycles where speculative demand dominated, today's market is increasingly defined by cash buyers taking direct delivery. This dynamic suggests that futures prices are being driven by paper flows, while the physical market quietly tightens beneath the surface. What makes this cycle fundamentally different, according to Schectman, is the behavior of institutions traditionally associated with price suppression. Instead of rolling paper claims or relying on warehouse warrants, some are actively moving metal into their own accounts. This gradual but persistent transfer of physical supply reflects growing concern over future availability and systemic risk. The process is unfolding deliberately, avoiding sudden disruptions while steadily reducing accessible inventory. In his assessment, this methodical shift toward physical control represents a long-term realignment of the precious metals market, one that favors sustained strength rather than a short-lived speculative spike. Now, we present the clips from Andy's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Beware of the guy who says it's different, but it is. It is. In 1980, you had a couple of brothers who noticed the same thing, by the way, that you see here today, more contracts than bars in the warehouse. And so they bought up all the contracts and stood for delivery. 2011, again, you saw a spike up to $50 for a brief second, and then it came crashing down because the fundamentals were very different. The United States was still the destination for safe haven inflows. Gold and silver were not yet recognized as critical, like silver is now classified by the U.S. government, and gold was not being used at that point to usurp treasury issuance or treasury holdings. We hadn't weaponized the treasury market yet. We hadn't done the things that has really coalesced the BRICS in the global South. And when you look at it right now, it's very different. You have sovereign nations that are accumulating this stuff under the guise of national security for all of their respective countries. And I think that's number one. The environment right now where I would say gold and silver have been recognized by the people that matter to be far more valuable than the dollars and other currencies that are being used to purchase them. It's very different. And when you see deliveries, back then no one stood for delivery. Nobody. I didn't start talking about deliveries until I did with you. You might have been the first one I talked about it with in very early 2020. Maybe even late 2019. It was somewhere in that neighborhood, but probably very, very early 2020, like maybe even January, February, we started to notice it. But that's where it began to change, where no one ever challenged the Western system, where you stand for delivery because you see something bigger. And people say, well, why don't they just buy it all at once? This is the genius of what these countries have done is little, where have I heard that before? Little by little by little by little. They've been doing it strategically, draining from all around the globe, and it's now accelerating. And now it's gotten the eye of this administration who says, if we don't join in, we're in very big trouble. As far as the volatility, back then in 2011, and I don't remember exactly how many times they did it, but I would bet my life they raised margins considerably. And let's talk about what that means, because they've done it twice here in the last 2 weeks, they being the CME group, COMEX. They raised margins. And the margin requirement prior to 2 weeks ago was like $21,000 would allow you in your margin account, just has to sit there in an account, that would allow you to control 5,000 ounces of silver. Let's put silver at $60 an ounce or whatever, $65 an ounce back then, just a few weeks ago. You're talking an awful lot of silver at 5,000 ounces. You're talking over $300,000 worth of silver controlled with $21,000 in your margin account. You're talking a very high degree of leverage. And when the COMEX comes in as the price is moving higher and raises margins, it's not about the safety of the market. It's a coordinated attack to blow out the leveraged longs. And what happens as the price goes higher, you get all of these traders, not the big boys and girls I'm going to get to in a minute, but a lot of sophisticated traders who think they're smarter than the market and don't have enough money to play in that sandbox. So they go in on leverage, they will go in on margin, and they will purchase silver at a massive degree of leverage using their money within the margin account as collateral, right? So the CME group says, no, we're going to raise margins, and they do it in thin holiday trading, when like right around the day after Christmas when no one's paying attention. And like that, if you don't post that extra margin, they raise it by 30%. That was the second margin increase. By 30%, you don't post it, your position's liquidated, just like that. I don't know how much time they give you, but not much at all. And so you have to post that margin, and if not, you have to liquidate your position. So there are a lot of people that are selling positions. Maybe they have 20 or 30 trades on, they have to sell some of them just to come up with the extra cash to fund their margin account. And so what it really is coordinated pickpocketing. They call it shaking the bushes, where these big traders, they're not that big, but big enough, but not rich enough, not deep enough. They go in on leverage, the margin gets raised, the price drops. People need to sell to cover their margin, which drops the price further, which it creates what do you call it a loop. It's like a doom loop where they sell to cover, which drops the price further, which creates more margin calls. But I had lunch at one of the owners of a Major League Baseball team. I had lunch at his house last week. Amazing house. And he lives next to Mark Wahlberg, the actor, and Alicia Keys is down the street. And these houses, which are kind of just across the road from my community, and you would never know it. It's so inconspicuous, you would never know it, that there are these houses back there. I had no idea. And you go through a gate, and the gate's set back about a half a mile, and so you can't see it off the road. But you go into these neighborhoods, and the houses start at 25 or 30 million. Do you think they care about what the mortgage rates are, these people? These are people that come in and write a check for $40 million for their house. And so the point of it is that the big traders, well, they don't care about margin increases at all. And these are the ones, this is what's different. You have sovereign nations. You have, like who stood for delivery in 3 days for 18 million ounces of silver and 500,000 ounces of gold in 3 days? I mean, think about that for a moment, the amount of money. These people don't care about margin. You're talking sovereign governments. You're talking Tesla, Samsung. What Samsung? They went to Mexico and struck a deal to open a mine. Sony, Panasonic, all of these, the photovoltaic companies, solar panels, they are coming in and standing for delivery off of margin. They're paying cash. The margin knocked the price down. And where are we today? we're right back up, right? We're not all the way there, but we are climbing because it just falls right into the hands of the big boys and girls who are standing there saying, thank you very much for selling. I'll take the metal. And if not, if you want to look at it from the other side that the banks are trying to cover, they just need to drop it to that price for 5 minutes so that they can get out of their shorts. They buy it back, price goes up again. So whether it be pickpocketing for cheaper metal or covering shorts by knocking it down, yeah, I mean, it's true. And then it's funny, now that the AI Asian guy you wanted to talk to me about is saying the same thing I said on your show 3 weeks ago. I swear he listens to us. He listens to us all because I know that he and the Economic Ninja kind of got into it back and forth. I know he quoted Bill Holter, and I swear he is saying things that I say too. It's AI that's scouring all of what we're all saying and putting it together. It's pretty impressive. Some of it's not right, but now he's saying the same thing I said on your show 3 weeks ago, which was that the Economic Times came out with an article saying that JP Morgan covered their shorts. They covered a 200 million ounce short position. 3 weeks ago, they said this. I said it on your show, and I said it on Adam Taggart's show, that they covered a 200 million ounce short position, bought 21 million ounces of physical, and are net long. And that the majority of the banks in the U.S. are in essence net long. Now, that doesn't mean they don't have short positions. They do. It just means that their long positions are greater than their short positions, meaning that they are in essence net long. And so if that's true, well, that would make the what we just saw here this week even more shocking. Let me read to you what that is.
The underlying dynamics of the physical silver market are becoming increasingly stressed, with supply conditions deteriorating in ways that are not immediately visible through headline prices alone. Product flow in the secondary market has slowed to a crawl, and commonly traded forms of silver are far less accessible than they were even weeks ago. This is not the result of fading interest, but of operational pressure building inside the supply chain. Rising price volatility has made it difficult for processors to manage risk, leading many to step back from taking new material until conditions stabilize. That hesitation has disrupted the normal recycling loop, leaving less refined metal available for dealers and end buyers. More importantly, demand behavior has shifted in a way that suggests the market is entering a new phase. Buyers are no longer reacting to short-term price moves, but are focused on securing exposure before availability tightens further. Trade uncertainty and logistical risk have compounded the problem, reducing cross-border supply and limiting fresh production from reaching the market. Financial measures that once suppressed enthusiasm are no longer producing the same effect, indicating that confidence in paper mechanisms is eroding. When physical markets reach this point, adjustments tend to happen abruptly rather than gradually. The current environment points toward growing dislocations between quoted prices and real-world availability, with tighter conditions likely to persist as competition for physical silver intensifies.
What good does that do me? I wouldn't say that stuff and destroy my family name and everything I've worked hard to build. I've been saying this on your show now for really since Thanksgiving 2024, I think.
Right.
And when it all went
over a year.
Yeah. I've been saying it doesn't make sense. The big money is draining the COMEX. The central banks are buying, but the public is enamored with AI and crypto. And we've talked about how largest allocation to the equity markets by the public, largest amount of option exposure by the public ever, largest margin debt ever by the public as the big money's draining the exchanges.
Insider selling,
public not buying any metal, where we've been able to sell junk silver below spot. Now, I want to explain that real quick before I get to the rest. The reason the junk silver that and I told operations, go on line of credit and buy every ounce of junk silver you can buy. I told them that, and we've had a lot, and I think you know that. It's an anomaly. You don't see it, right? Now, why am I able to buy junk silver below spot? Can't do it anymore. It's starting to change. Because the refineries that accumulate this stuff, and not just junk silver, any form of silver doré, or jewelry, or candlesticks, or junk silver. They have it all in the line of production. It takes time to refine it into shot, which are like little BBs or ball bearings, They have to pull out all the impurities, make it pure, then turn it into shot, and then they melt that down into bars and rounds. And this chain of production can take weeks, several weeks. Now, if I have 3 million ounces in our warehouse, which we often will, we'll sell 3 million ounces on COMEX, because if the price dropped by $10 or 2 weeks ago, $7, or a week ago, $7 on 3 million ounces, you're down $21 million. How fast are you going to go out of business? So we sell short on COMEX at exact same amount. One goes up, one goes down. We've explained this before. It allows our inventory to be held market neutral. The refineries have to do the same thing. The refiners have all of this metal in various stages of production that they paid the public for. They need to hedge it. Difference is we're constantly rotating, so we have cash flow. They don't. They have it in various stages of production. It may take 4 to 6 weeks from intake in an impure form into finally being a ready-to-go bar or round. They're getting margin called. They're getting margin called because the price is moving up too fast on their short position that is used to offset their inventory. And now they have to cover that or add more margin. And when the margin goes up, they get even more hammered, right? So they stop taking orders. And that's why junk silver pre-65 dimes and quarters were available to me at below spot, because the refiners weren't taking it. Now, the big dealers like me who realize it said, go buy everything you can find. But there are dealers, small and mid-sized dealers, thousands of them all throughout America that don't know what to do with it. So they bring it to the refiner. The refiner says, I don't want it anymore. So then they sell it begrudgingly to the big houses who are paying below spot for it because they know the pinch that they're in. And then I will go to the big houses and to every other dealer that we work with and say, I'll take everything you have below spot. It's a once in a career type of thing. It's not something you see very often. I use that as a gauge because premiums on that have gone up, what, $1.50 or $2 in the last week or so, and will continue to move higher. So things are disappearing. Now, as far as the bars, why are there no 100-ounce bars around? Why are they so hard to come by? And why are they priced so much higher than they should be? Because of tariff threat. Most of the bars come from, well, Royal Canadian Mint. No, tariff there. Switzerland, tariff there. When you talk about Argo Herreris, Valcambi, PAMP, Metalor, all of these primary refiners around the world that provide the brand new nice 100-ounce bars, the dealers said, I'm not taking that in and risking tariffs. So none of that stuff came in. So bars are hard to get. The pre-65 silver is going up in price and now very hard to get. Silver Eagles are disappearing. We just sold out of the 2026 Kangaroos. Everything is disappearing. And just like that, it happens every time. And I told people it would, and I think you'll see premiums go massively higher, especially as people wake up to the reality that this is for real. And if you haven't figured that out by now, you're not paying attention, because going back to what I said about the margin increases, in years past, that would have broke the back of the market and would have never have come back for a long time. Like it happened in 2011 at $50. What did it take? Another 14 years to see that broken to $50. This time they step on the margin and the market laughs and says, thank you very much. I'll just grab everything I can on the cheap. And it is now becoming a race by sovereign entities to accumulate real stuff. So what am I seeing in the marketplace? I'm frightened by it. I am. I'm frightened by that. Here we go again. Having a hard time securing and sourcing product, and you'll see it on every single website in America. And it's only going to get worse, in my opinion. So we're not even running a special this week because I'm so concerned about, supply. And we've been doing this longer than anybody, right? This 36 years next month. Most of the companies are a third that old. I know everybody. All the big importers, all the mid-size, all of them. We have accounts with every one of them. And I'm telling you, it's not getting easier to get this stuff. And you have to really work your relationships, be the first to pay, the first to take things maybe you don't even want, so that the next time something comes, you're the first one to have it. So, yeah, it's crazy what's happening within the marketplace right now, Dunnigan.
Looking ahead, the next phase for precious metals is likely to be defined less by speculation and more by structural change. As inventories continue to thin and replacement supply struggles to keep pace, the market may shift into a period where ownership takes priority over price sensitivity. Short-term pullbacks could still occur, but they are increasingly likely to be met with rapid absorption rather than prolonged weakness. Over time, this dynamic can force a reevaluation of how value is assigned, particularly if access to physical material becomes inconsistent across regions and channels. If these pressures persist, pricing behavior could begin to reflect scarcity rather than sentiment. Gold may increasingly be treated as a reserve asset rather than a trading instrument, while silver could experience sharper moves as limited availability collides with rising industrial and monetary demand. Such conditions often lead to sudden repricing events rather than gradual advances, catching unprepared participants off guard. As confidence in financial intermediaries continues to be tested, the emphasis may shift decisively toward tangible assets, reshaping both market structure and investor strategy in the period ahead. Share your thoughts in the comments section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.